So there's a strong correlation to everyone's daily lives and how they're feeling bad about the economy. There's not any clear indication at all whatsoever that people's feelings about the economy is related to the stock market performance.
To have a market at these levels with some bearish indicators probably indicates to me, at least, is that this is not a bubble that we're looking at in the marketplace.
Welcome back, everyone, to the Geeks, Geezers, and Googleization Show, the home of Googleization Nation, where we talk with HR and business thought leaders about the crazy, never normal shift going on all around us. Our goal is to bring you ways to reimagine tomorrow and explore the ever-changing convergence of people, business, and technology. Here is your host, Ira Wolf.
Welcome back, everyone, to another episode of Geeks, Geezers, and Googleization, and the second edition of our new monthly series at the corner of Main Street and Wall Street, where we'll be talking each month about the convergence of economy, politics, and technology. We realize you have a lot of listening and watching options and are grateful you've taken the time to join us. We're sorry we're a little bit late this morning. We had a little bit of technical difficulty, but we're here now. Hopefully, John Aiden Byrne will be joining us, but I've got Matt and Jim in the green room. Joining me, as I just said this morning, will be two familiar people, Matt Van Alstyne and John Aiden Byrne. And a special guest we'll be having is Jim Toes, President and CEO of the Security Traders Association. On today's show, we're going to be tackling a couple things, and it may be diverted if we get a major news break from the Supreme Court. But anyway, we're going to be asking a few questions. What does it mean to Wall Street and Main Street when the market cap of 7 of the top 10 companies in the world, they're based in the U.S., and their combined market cap is greater than every country's GDP in the world except the U.S.? Just had a great question come across the board while we were waiting to go on the air, and it was, is NVIDIA a big enough company or big enough now to host the Olympics or the World Cup? Is Main Street inflation really falling when motor vehicle insurance rates are increasing over 20% annually and housing costs are still rising at 5 to 6% annually? Do people on Main Street really care about the record highs in the S&P, NASDAQ, and the Dow when just 40% of the population aren't invested in the market, and even a smaller number have money invested in retirement plans? And hopefully we'll have time to tackle this one. How is Wall Street planning for our post-election economy? So to answer these questions, I welcome back Matt Van Alstyne, co-founder and managing partner of the Odeon Capital Group, a leading full-service boutique broker-dealer to institutional clients. Many of you know Matt from his commentary and outlook on the highly rated Odeon Capital Conversations, which will be returning soon for another season. We've got John Aiden Byrne, veteran Wall Street business journalist, editor, filmmaker, and successful podcast host of Odeon Capital Conversations and Dig Life Deep. And John's newest ventures are 2 movie projects, one on the legendary life of a Wall Street CEO and scholar, and the other on Norman Rockwell. And our special guest, as I mentioned earlier, is Jim Toes, President and CEO of the Security Traders Association, a grassroots trade organization which serves individuals employed in the financial services industry. STA, by the way, is hosting their flagship event in the fall, the 91st Annual Market Structure Conference. This year's theme is Shifting the Landscape, and is scheduled for September 18th to 20th at the JW Marriott, Grand Lakes, Orlando. We'll put the link to that, and I'm sure Jim can mention it, but you can go to securitytraders.org for more information. So at this point, I'm ready to bring on our guest panel. Welcome to Matt, and welcome to Jim, and gratefully welcome to John. John, you mastered the technology. You're here.
It's a high-tech age.
It is.
You got to get with the program on Wall Street.
Yeah. Yeah, and these are some of the challenges that are happening on Main Street as well. So, So you heard my lead in there. Let's get right into it because we were a little bit delayed. These numbers have changed. I didn't look in the last 10 minutes, but looked like NVIDIA was still becoming a larger and larger country in the world. But I pulled these up. Let me see if I get the right ones. So here's a graphic, and this is probably 2 days old at this point. But you can see that big news in Wall Street. I don't know if on Main Street, but definitely on Wall Street. Now, NVIDIA is now the largest cap company in the world. It's followed by Microsoft, which it overtook, and Apple. So within the last month, I think it surpassed both of those. But then you look down the list, and you got Google, Amazon, Meta, Berkshire Hathaway, and Eli Lilly. So these are 7 of the top 10 are in the U.S. When you look at either of the top 3 combined if you combine any of the top 3, it's now bigger than the GDPs of every place but China, bigger than Japan, Germany, India. If you put all the combined together, the top 7, it's approaching the size of China to become the number 2 country in the world. So I guess my question to whoever wants to tackle this one first, what does that mean for Main Street? What does that mean for the U.S.? What does that mean for the world, for the global economy, when 7 of the top 10 market value companies are based here, and their total market cap is nearly as great as China, which would put it at the number 2 place in the world? So I'll throw it out to you guys.
I think I'll let Jim or Matt go first.
Yeah, I'll let Matt go first. Yeah.
I kind of feel like you're comparing apples and oranges. I mean, there's a few things that kind of stick out. One, comparing GDP, nominal GDP, to market cap, you're kind of, GDP is economic activity. Market cap is the present value of the future earnings of those companies. And it's, if you were to actually present value the future earnings of America or China, you wouldn't have the same comparison, being relevant, because the market value of America has got to be, in the quadrillion range. If you're going to present value the revenues and the assets and, all the natural resources that America has, and same with China. So, but one thing that sticks out is when you see these 3 companies that are just so big, and they're trading at multiples and multiples of their revenues, not just earnings, but 20 or 30 times their revenues. Either the market's right, and what you're doing is you're saying that these companies are going to capture most of the efficiencies of the AI boom, and the rest of the economy is just going to get dragged along by the AI boom. And it's entirely possible. I've spent decades listening to people talk about how Tesla is massively overvalued, and over time they've kind of grown into their valuation where you can do back of the envelope math, which says, hey, maybe it's not crazy overvalued, because they are so dominant in their space. And they're you see these other competitors on CNBC talking about how they have better technology than Tesla, and they're losing $1 to $2 million per car sold because they can't do it efficiently. They might have better tech, but not really if you can't make it efficiently. So NVIDIA, they have such a head start on everyone else. It's hard to see how anyone's going to catch up, but it's also hard to imagine that at some point there isn't efficiencies brought into the market, and they'll have their competition and have to compete against someone making a similar technology at a lower price. But that sure does seem to be decades off. So I think it's interesting, but I don't think it's necessarily the most interesting thing out there.
Yeah, I mean, so I agree with the first part that Matt was making around, probably shouldn't be comparing market cap to GDP on things, but it does, obviously the numbers do tell a story, and you touched on the consolidation within the performance under a small group of stocks, and then when you even look a little bit deeper on that, this small group of stocks are really tied to one major investment thing, which obviously is the AI, right? AI, and even obviously Amazon's got a big stake in that as well with their cloud computing, a lot of this AI stuff requires a lot of data storage, and Amazon obviously does well, and that as does Google for that matter. So listen, I think that if we were talking trains, probably U.S. markets wouldn't be on the top 7, right? If we're talking fast trains, right? We'd be talking Switzerland, Japan, and France. They do a great job on fast trains. The U.S. has an incredible financial services industry, right? And I don't think anyone does financial markets better than us. It rewards innovation that we're seeing with AI, and then not only does it reward it, but it also provides all the tools on the front end for companies who maybe start with just having an idea and a couple of people in the garage, and then everything that kind of gets wrapped around that as far as confidence and resiliency and how the markets perform, protection under the laws that don't really get enough attention. The ability for patent protections and so on and on. So listen, I mean, it is a little, it doesn't make you feel, do you feel great about it? I mean, yeah, obviously you kind of wished it was spread out, but sometimes the concentration there is, I don't want to call it a trickle down effect, but these companies, they are obviously, I'm sure that NVIDIA is the largest customer for a lot of small and mid-sized companies, right? So there is some diversification in there as well.
Yeah, Matt talked about metrics and how you measure everything, because the largest company in the world today by revenue is Walmart. It's a retail chain, and we know that 66% of the US economy is made up of consumption. So a lot of that may not be surprising, and then followed by Saudi Aramco, Amazon, and then the state grid of China, and then Apple falls in place somewhere there. We don't know where all this is headed, but it's worth pointing out that the Wall Street Journal did a great piece on it this past few days. NVIDIA's ascent to the most valuable company echoes the dot-com boom. And they were quoting from somebody there. That may not be true. The chip maker passed Microsoft for the top spot recently. Capital Economics' Neil Shearing on Monday said, enthusiasm around AI has all the hallmarks of an inflation bubble, referring in part to NVIDIA, and he sees this bubble eventually bursting in 18 months. He may or may not be true. Obviously, AI, NVIDIA, and all this hold massive potential for new discoveries, for medicine, for intellectual capital, to raise our standard of living. But there's not a lot of earnings growth here, or somebody had a number. Generative AI startups have only brought in $3 billion in sales, while $50 billion was invested in NVIDIA chips. So this analyst sees a striking imbalance in market cap and these numbers. So it's great to have them on the top, but buyer beware at the same time.
Yeah, so I mean, listen, I'll take that in two parts, right? So I won't really talk about like is there a bubble in NVIDIA on that? But I don't think there's like a bubble in this marketplace as far as where we are at these levels. I mean, there's so much skepticism / bearishness out there. I mean, so many negative indicators out there, whether it's inflation or the government stimulus looks it's going to come to an end at some point. We got large government debt that's unsustainable, immigration policy. I mean, there's so many other data points that people can look at that people are very skeptical about investing in this marketplace. And I know this sounds crazy, but that level of skepticism is a bullish reason to believe in the stock market at these prices. Right? So I mean, if everyone was euphoric on everything, and the market's at new high, then that's obviously a part where we would be concerned after kind of going through something on this. But I think there's a lot of negative stuff, negative indicators out there, and which are telling a bearish story, people's sentiment. That I think to have a market at these levels with some bearish indicators probably indicates to me at least is that this is not a bubble that we're looking at in the marketplace.
So I guess the question, I mean, when we look at Main Street and Wall Street, with this, obviously there's people flush with cash now, or at least in paper money. Retirement funds are going up, personal investment portfolios are going up, but with 50% of the population not invested in the market, with more than 75% of them of people in mid to lower class do not have a retirement plan. Are we just increasing the divide? I mean, are we just having this increasing wealth gap, which is sort of the underlying theme of, are we better off today than 4 years ago? And there's a group of people that says, we are. And there's a whole other group that says, no, we're not. So how with a concentration in these, 7 companies, but 5 AI-driven companies, are we going to increase this divide, and are the fortunes of our economy consolidated within 5 companies?
I don't think that's fair to say the base of the economy is consolidated into 5 companies. As John pointed out, Walmart is the highest revenue company. Saudia, the Aramco is a high revenue company that doesn't have the market cap. They don't have the market cap because they don't have the growth projections and the margin projections. Going back to are we, I guess you mean like a society creating a bigger divide? Well, I think it's abundantly clear that the stock market should not be a proxy for anything except it shouldn't be a proxy for anything. I mean, there is a wealth effect for the people who are invested in it, but I mean, you don't have to drift too far into the Wall Street Journal or Politico or any of these other, political rags that talk about how people are very upset with the economy. And you have Biden running around, well, not exactly running, but, shuffling around saying, the economy is great. Look at all these metrics. Look at the S&P. Look at inflation. Look at unemployment. Look at house prices. Look at everything that's been good since I became president. And he's kind of missing the point that the feeling that people have is when you go to the grocery store and you have to spend $10 to get a dozen eggs, and you remember a couple years ago when they cost $2, and you kind of think, am I crazy? Like, this is really expensive. And there's data that shows that wages have finally caught up to inflation, but that's just the headline number of inflation. And when you drill down, depending on your personal economic circumstances, the lower your overall and average income, the higher the share of your wallet goes to the highest inflation items. So there's a strong correlation to everyone's daily lives and how they're feeling bad about the economy. There's not any clear indication at all whatsoever that people's feelings about the economy is related to the stock market performance. So I think the stock market performance, when it comes to Joe Biden's reelection, I think it's one of those things that if it were down dramatically, it would definitely hurt him. But he's not benefiting because it's up, because the psychology is, felt at the grocery store and at the gas station, not watching TV at night and seeing where the stocks went.
Yeah, I mean, our stock market, to that point, our stock market, these top 7 companies, these are global companies, right? It's not, when you start growing today, it's not enough to be number 1 in the U.S., right? You want to be number 1 in the world in these areas, and that obviously just contributes to the largeness and concentration of these 7 companies, right? And then, there's also this other area. There is a government influence on this as well. I mean, regulation obviously has been the theme for the past 4 years, not just here, but in overseas as well. And regulation has a real cost to it, and it's really only the large companies that can kind of bear the cost, and it does put a burden on the small to mid-sized companies. So on the one hand, you have like this our marketplace and the stock market that's playing on the global scale, but then when you come home to the local consumer and this wealth gap that you're talking about, there are people that are feeling, a lot of people are feeling the effects of inflation. I mean, it's just the cost getting to work now is incredible. The cost to get to work right now, if you're commuting into the city, is incredible, and whether you're driving or whether you're taking transit, it's meaningful. Food obviously is up, and it really does impact. And then there are things we can be doing about it. We can talk about that later as far as there are certain things that regulation and government can do to kind of close the wealth gap, that providing opportunities for investors to maybe invest in areas that they're not allowed to invest in because they don't meet some standard rule around it, but it's also, it's other things as well.
The back to what Matt said there about the divisions, I don't think you can say the stock market exacerbates divisions because some people are invested, some are not. That is in part a personal choice, obviously, but you can get good data on the wealth gap in America through the Gini coefficient. I think there's been sharp that the wealth gap has been widening for quite a few years. But inflation is probably one of the greatest threats to the well-being of the middle and poorer classes because so much of their pocketbook, back to what Matt said, is on those items like housing and clothing and food and so on. And housing costs have gone up, I think last month, about 5.4% in or around it. That's a lagging indicator. We know that. Yeah. But rents are rising and along the Northeast. And the latest poll out today shows that Americans are feeling very down on the economy, 54% of them. So Biden could do something about that. Donald Trump could do something about it. I mean, he spent $7 trillion or something in the last couple of years. And Trump also spent excessively, obviously. So that contributed to the inflation we have seen clearly. And I think we may be entering a more difficult era with all the COVID spending savings being pretty much depleted. So, I would say inflation's a bigger bugbear for, the wealth, the divisions in wealth in America.
Yeah, and if we go back to, I mentioned this briefly, and I just didn't want to overlook it. The fastest rising inflation at this point, it was groceries, is now motor vehicle insurance. I mean, and it was up 22%. I think it dropped a little bit. I think it's now down to 20% increases. But when people get that bill, and the vehicle, wherever you are, it doesn't have to be coming into the city. It could be in rural Iowa. When you get a bill that's 20% higher than it was before, fuel costs have come down, but they're still rising at about 2%. You go to the grocery store, it's down to about 3%, but down from 11%, but it's still there. Is every day the pocketbook is getting hit. It's costing more than it did before. And while even if 50% of the people do have investments and they do have a retirement fund, it's not helping them day to day. It's not helping paycheck to paycheck. We lost a few minutes in the beginning, and then I know, Jim, you have a hard cutoff at the end, and we want to give you a break between one meeting and the other. But we've been skirting around the issue. I mean, we've got an election coming up. I can't remember the count, but it's like 138 days, I think, today, or something, 137 days. How are you planning? All three of you, how are you looking toward the post-election economy? What's that look like? Because obviously there's huge divisions. Some of the promises that are being made probably won't come to being as they always have, but it's not that it's something that people got to think about. It's not, hey, we'll wait to see what happens and then it's going to run. So how are you approaching the next 5 months as far as your organizations, your investments, your clients?
I think the assuming that there isn't political chaos, and I think that's a bad assumption to go and start with. But generally,
that's a third option. Anarchy.
Generally speaking, the market starts pricing in the winner of the election when it's clear who is likely to win. And right now, I think, in my opinion, is the market's kind of pricing in a Trump victory, because the market's not looking at Joe Biden's proposed budget, where he was taking corporate taxes, I believe, from 21%, which is Trump's rate, to 35%. That's going to, if that starts to looking like the standard outcome of this election, is that taxes are going to rise, government spending is going to rise, red tape is going to rise. There's no relief to this, laggard economy that we really have. It's not a healthy economy. It's an economy that's running on, we think we're getting Trump back, and that's going to free up, capital, and it's going to free up economic activity. It's going to free up animal spirits, and it's going to do something to reduce the amount of money we're spending on wars. And it's going to, like that optimism is built in. And if Trump wins, you have a very, very good chance of the Trump tax cuts being extended, which expire in 2025. So that'll start getting priced in. If it starts looking like it's going the other way, I think the Trump tax cuts not getting extended is going to start getting priced in, and the market will take a significant downturn just because of the math. The maths are going to say your future earnings of these companies are going to be 20 or 30% lower under the Biden tax increases if he starts to looking like he's going to win. So I think, and also I think you're going to start seeing companies looking towards layoffs and other activity because they're going to have to figure out a way to juice their earnings under the Biden tax increases if that has to start getting priced in. So I think it's really like a poll watching thing. And, you can watch the markets, you can watch the betting markets. Right now, everything seems to be lined up for Trump. And so I feel like the economy is kind of getting geared up to go into, financial overdrive if it looks like Trump indeed will become president. And what I'm really saying is not Trump per se. I'm just saying the Trump tax cuts is a big, big factor, I think, in how the stock market's being priced right now.
This is such a unique thing that we're going through right now with these two candidates because it's the only time that we've, at least in my lifetime, and it's only happened once before, where we all lived under a Trump presidency for 4 years, and then we've all lived under a Biden one for 4 years. So in some ways, what's the one thing that our markets tend not to like, and we tend not to like uncertainty, right? I think people are getting a lot of confidence in knowing that at least they're going to know what the outcome. Does anyone doubt what Trump's going to do if he gets in again? Like, is he going to be a different person all of a sudden? Is he going to have a different beliefs or different policies? No, he's going to look to do what he was doing between 2000 and 16 up to 20. So that's kind of a unique thing. More specifically, though, we do see on our side. On the House side, we are seeing some jockeying on getting some pieces of legislation in place. Obviously, on the House side, with that will be ready to go when should Trump win the presidency. And I'm talking about this FIT 21 bill, which is around, it's the most comprehensive legislation that exists in Congress around digital assets and stable coins, and is it a commodity, is it a security, and the whole crypto industry. So that for now, that is technically that is it was a bipartisan bill. The topic of around crypto is still, knock wood, hopefully it stays like this. It is a nonpartisan issue. There are some Democrats who see the value to this technology of blockchain and some of the values, especially if you're in a low income neighborhood, that you can see some benefits that you can bring to your neighborhood on this, and they see the benefits of the stable coin and being able to, take assets that are, whether it's artwork or your house, and you can put it on a blockchain and sell some coins on it. So that's more specifically, but that's, listen, it's gonna, we'll see what happens. There's still, I'm a believer it's still the economy, but elections have, the elections have consequences, and the ability for presidents to come in and be aggressive on executive orders, their policies some of their policies get enacted pretty quickly.
The one everybody is watching, or a lot of corporate America, obviously, Matt referred to it, the corporate tax rate. Biden wants to raise the current rate to 28% in or around, and some of the GOP favor 15%. The current rate in America is 21%, I believe. Also, Trump is proposing replacing the personal income tax with trade tariffs. We don't know if this is bluster. He's talking about getting rid of taxing tips. That's going to play to a big constituency. Robert Shapiro, who's no fan of Donald Trump, he worked in the Clinton White House. and he said that claims if Trump replaces the personal income tax with tariffs, it would cripple U.S. trading, growth, and employment prospects, and it would trigger the worst inflation since 1980, would damage trade, and it harkens back almost to the 1920s. If you start messing around with tariffs and so on and putting up barriers, but maybe we're in a whole different era, and this maybe now it's all different.
Yeah, I mean, going back to that, I just saw there was some kind of review of history, but that was in the late 20s and early 30s. There was the Smoot-Hawley Act bill that was put in, and if that's an indication for politics, is it was a Republican move, and Smoot and Hawley were put that in, and Hoover signed it, and all three lost their elections. So.
Yeah,
probably not a good sign. Again, 100 years later, it's a different economy, but
I feel really uncomfortable when I get into positions defending Trump because it's not my natural state. But the Smoot-Hawley tariffs were imposed, I believe, is 1933, 3 or 4 years after the Great Depression already started. It was under Hoover.
No, it was signed in. It was signed before, right before. It was signed before the Hoover Roosevelt. That's why Roosevelt won.
But it was after 1929 is my point.
After 29. Yeah, you said after 33. Yeah.
I think it was in 1933, or maybe it's 32 or 31. It was after the Great Depression.
Yeah.
And when you talk or you listen to Trump when he's coherent, which is, sometimes more frequent than Biden, but, not as frequent as you'd like it to be, he refers to the McKinley era and the McKinley tariffs, and those were imposed long before Hoover became president, and he seems to think that is a more positive correlation to the people who are saying, no, look at Smoot-Hawley and look all the damage it did. I am not trying to defend him. I'm not trying to argue that tariffs is the way to go, but when you compare his ideas to Smoot-Hawley, I think you're missing the mark a little bit, because he looks at Smoot-Hawley and says, no, we're not doing those types, we're doing the McKinley types, whatever that's worth.
Donations from Wall Street to the Republican campaigns are running at 70 million, I read, versus 40 million on the Biden going to his campaign fundraising and affiliated arms. So a lot of the Wall Street money is headed is skewed towards Trump. It's just by that metric. But there's other kind of donations we probably can never actually measure and are not classified as Wall Street money, but it's big money.
DJT stock. Let me go back to AI a bit, and just some of the I won't say collateral benefit or damage, but just some of the side. I saw this the other day, and data. John brought this up as well to me in planning this. Data is the lifeblood of Wall Street. I mean, that's where we are. So we got high-speed trading where AI is going to go. But in the background, in order to make this work, we need massive, one of the biggest growth areas is massive data centers. We're just growing these data centers, but they need to be powered. And I pulled this up, and this was just from Virginia alone. The computers the computers in massive data centers are processing nearly 70% of global digital traffic. And they're gobbling up, I'm just reading this, gobbling up electricity at a rate officials oversee the power grid say is unsustainable unless two things happen. Just in Virginia alone, they need 700 miles of new transmission lines must be built, which they are, in order to do that, they need to go through neighborhoods and farms and 3 neighboring states. And they also are some of the coal mines that were scheduled to go offline, not the coal mines, the coal generators that were scheduled to go offline are now being extended. So the AI effect is creating an enormous demand for energy, which is taxing our power grid, which now leads back to Main Street America when you start talking about running transmission lines through neighborhoods, taking over farms, shortages on electric. These, again, going back to what Main Street's talking about, is they notice their rent, their mortgage, their groceries, their insurance, and their energy. And just the other day, I mean, this was on a little side neighborhood chat, people complaining about their waste management, not waste management, the companies, just in general, their trash pickup bills, have gone from 180 to 700, somewhere between $500 and $700. Those are the things that impact people on a daily basis. And again, what did they relate that to? The cost of groceries and the cost of gas, and the increases of many of the waste management industry workers were earning minimum wage, maybe up to $10 or $12, and now they're at $15. So those costs get passed along. So the impact of AI, at least on Main Street, nobody seems to be talking about it a whole lot, but it has an enormous effect unless we got some government plans to help anticipate the needs and investment in it.
Well, I'm sorry. We have a government who, and maybe it's the global leaders altogether, for the first time in history, are transitioning away from the most efficient energy source to a less efficient energy source. It's the first energy transition that the world, at least recorded history, has ever known, where you've gone from more efficient to less efficient. Usually you're going from less efficient to more efficient. The transition from whale oil to whale blubber to carbon based energy, or the transition from wood into coal, or the transition from coal powering steam to other more efficient powers of steam. Society has gotten wealthier and wealthier, going back from 200,000 or 300,000 years ago, when our ancestor first crawled out of the primordial soup and found land. Energy efficiency and increasing energy efficiency has been the hallmark of humanity, and we have leaders now that are going the other direction. And of course, it's going to show up in prices. Of course, it's going to show up in less efficient mechanisms of transportation, or less efficient uses of energy resources. And then scarce resources drives up price. So this is purely a policy decision to tax the American and just energy consumers for policy reasons, and there's nothing else to it. We could have low cost, cheap energy if the government put their mind to it and made that a priority for the people. And people should react, and if they don't like their leaders, they should vote them out, because they're doing humanity a disservice by transitioning from efficient energy to inefficient energy.
Could you be just specific about that, Matt, what we're referring to?
The amount of energy it takes to create so-called green energy makes all green energy, aside from nuclear, and that some people debate that that's not green. Aside from hydro, some people debate that that's not green. But wind energy, battery energy, solar energy, all of them take more energy in the creation of the energy than they'll produce over their lifetime. So it's a net loss on resources. Now, I do know that people argue you have to go through this transition period so you get to the point where you have the batteries, so you have the windmills, operating when the wind blows, and it's stored in batteries. Then it gets more efficient over time, but the math just so far hasn't worked.
Yeah, you mentioned there, Ira, about the US being the global center for data processing, it sounds like, because there's something like 5,000 data centers in the US, many of them concentrated in the Virginia area. And Germany, China, and UK, they don't even come close. This is a gigantic footprint, like massive football fields of data centers. And the spike has been driven also in part by EVs, electric vehicles. So, they talk about green energy, but these EVs create a lot of consequences for us that they haven't been properly addressed.
Yeah, I mean, listen, we need a much better energy policy. We need reliable energy resources for this, and all these energy resources that we talked about here, they all have trade-offs. Okay, and And the part that I think that I just find disingenuous about the conversations around green is that they don't acknowledge the trade-offs and the negative impacts that these have on the on the environment that they're supposed to be trying to save here. I mean, we're devastating our oceans by putting up these turbines out in the ocean. We are. Obviously, I'm sure you probably all read earlier this week on the. I learned for the first time the amount of water usage that goes into mining cobalt is like you need an enormous amount of water to do this, and they just shut off all these water lines to these farmers in Idaho because they're going to turn the water on to mine the cobalt, and they know if they turn the water on to mine the cobalt that it pollutes the water, and they don't want that obviously getting into the food supply, right? So listen, there are trade-offs on everything. We need reliable source. I've always been a believer that it should be the solution is really an all of the above that includes nuclear on it. And I'll just say one more thing around this too. I mean, the amount of when you read some of the stats here, as far as like the amount of energy that gets used on an AI search versus a regular Google search, it's a pretty big multiple. The move into crypto, when you talk about the mining function that is performed in crypto for verifying transactions, an enormous amount of energy is used in that. Obviously, we have a society that's turned on, plugged in 24 hours a day. John, you touched on the electric vehicles. I mean, the demand for data, the demand for equals demand for energy, power grids, and we need a better policy, and it has to be something more along the lines of all of the above, and in a realization that there's going to be a trade-off for whatever decision that gets made here. But let's just at least have an honest conversation about it.
An interesting stat: the NYSE and Nasdaq generate over 10 terabytes of data daily. I understand that terabyte is huge and massive. You might know, Jim, but
oh yeah, well, sure. I mean, I'll tell you that real quick where it's coming from. I mean, they put in place this consolidated audit trail, which is supposed to be the main tool for monitoring all activity in the marketplace, orders coming in, how they're getting executed, how they're being handled. This data center that they have to store it is the second largest one in the world. Okay, only the NSA has a bigger one. The estimates that they had when they were going to build this they were off by a multiple. It's around 6 to 8 times more. We call it message traffic, right? Every time there's a change in a quote, that has to be reported to the consolidated audit trail. That is a reportable event. All right, we're talking 600 billion reportable events per day, every day.
Wow.
Going into, and they were estimating it to be around 80. So, and it's not a function of volume. Okay, it's just a growing industry. So, yeah, I mean, the amount of data that you talked about, that this probably mostly is what you just kind of talked about.
Hey, we are coming up close to the top of the hour here, to the end of the show. A great conversation. I'd like to just go around the room here and ask a question because we'll be back next month, hopefully. Jim, I know you've been you sponsored the last one and you're here today. Hopefully you'll be involved. Just want to get a take over the next few weeks. What will you be watching? What are your eyes keen on, from a Wall Street point of view? So let's start with that.
I mean, first off, all eyes have been on the Fed. You walk into the year and the Fed is predicting, I think officially, 3.5 to 4 rate cuts, and now they're down to predicting officially 1,
maybe.
But I think most people are kind of moved on to the camp of they're not going to do anything. If they do, it'll be in December after the election. Maybe it'll be in response to the election. But I would point out that historically speaking, the Fed rate cuts usually come as a response to some sort of extra Fed event, like a bank failing or, long-term capital markets, in 1998, or a currency failing or something. It's a response. Usually they'll cut rates, and they'll cut rates because something bad has happened, and they're trying to they're trying to overreact to keep the economy going. So I think you could accurately predict lots of things, but you're only going to be right on one of them. And one of them that you look at is the debate next week. The rumor mill is full of, hey, this is Biden's chance. If he melts on stage, the Dems can replace him, and that could shake up the entire election entirely, because they might replace him with someone who's actually popular, and it could really change the way it looks. And like right now, it looks like a 50-50 election, but it could easily be a 55-45 election if you get someone that actually is competent and wants to do the job. So I would look at something like that. I would also just look at the French elections. I mean, that could be really, really interesting. That's July 7th. And if you're following along, the Europeans, in 2016 voted for Brexit just before, America voted for Trump. And it looks like right now that Marine Le Pen, which is, she's labeled as a far right, anti-establishment, she might get an outright majority in the French Congress, which would kind of put her in a position to challenge Macron in 2 years. And you might have a complete sea change of how Europe looks. And that could happen before our election. So those are the two things I'm looking at: is does Biden make it all the way, and what happens in France?
Yeah. So he took one on the elections. Obviously, it's something like 40% of the people on the planet are voting for their leadership this year, right? That's something that doesn't happen all the time, and there seems to be some pivoting away from past trends and going into a different direction with what we've seen on some of the outcomes. So that's something. Obviously, John, you also touched on the Supreme Court rulings that are anticipated. That's something for us to be watching. I mean, listen, I hate to say it, but we tend to get a little bit more political unrest or protest seems to happen more in July and August than they do in January and February in our country. People don't want to protest in Chicago when it's -5 degrees outside, but in July it's when the weather's nicer. So I just hoping that we don't start getting some of the protests that maybe we've had going into past elections on this, and then we'll see how the geopolitical events play out. But I think, though, I mean, I'm probably going to, regret saying this, but I mean, it seems like, as far as on the legislative side, on Congress and the Senate, they've kind of done whatever they haven't done anything, that they were they're done for the year. All right. They are now in 100% election mode. So probably not going to see anything drastic come out of there. So then, what's going to be dominating the news cycle will be just all about that, the presidential level. And, but it's not going to be a dull summer. That's we are not in. It's going to be an active summer. It's going to be an active fall, and we're not going to get any peace or calm anytime soon.
Yeah, it's going to be a hot summer, Jim. I'm going to be watching the debate next week on CNN. And by the way, there's going to be breaks for the first time, and everybody's saying, well, it was, the Biden team leaning on CNN to give them some kind of a break. I think it's for the advertising revenues. They're going to make millions on advertising, millions over that whole 3-day period. And if Biden fails on it or doesn't perform good, who knows? Could be game up for him. But besides that, I'm going to be watching the Cubs and Mets game on Sunday. Just get away from all this mayhem. Matt referred to the elections. I think this is really a fascinating time in history. Everybody says there's a shift in Europe and in the US, and I actually don't know if it's that simple. I think there's volatility in our Western world. I'm going back to a theme I brought up because we're in the grips of this moral relativism, and people don't know which way to act. Our institutions are under attack, our educational establishment, law and order, our judiciary, our families. There's radical ideologies out there, and everybody's tossing coins. Maybe Trump will fix this. Maybe, so people don't actually know what they believe in anymore. They're so easily manipulated. And that's the scary thing about our current, not everybody, but quite a percentage of people are quite easily manipulated by media and by some of their leaders. And I just hope we do have a good, uprighteous, moral leader who will do all the right things, whoever that is.
Well, as I describe our world of being never normal, I think we set up what next session, what next month, some of next month's topics will be, and in anticipation, we'll know what the first debate was, and we'll get the results from France, and who knows what else will take place. I want to again thank Matt and Jim and John for joining me. We're at the intersection of Main Street and Wall Street. Jim, you've got I mentioned it early on. I'll give you a chance to kind of plug it again. You've got your conference coming up in the fall. I think I got a banner here, but if you want to just give a few short words about it.
It's, we have our annual conference. We usually have this one down in Washington, D.C. It gets a good draw down there. We shifted it down to Orlando this year. And, there are so many issues going on in our space. If you're in equities, if you're in ETFs or options, this is a great conference for you to attend. It's a great, a lot of education, a lot of networking going on. Check it out and, come on. We will be live streaming a couple of the speakers on it. We have a couple of, I don't want to, give some of the bigger announcements, but we'll have some announcements coming out next week with some of the bigger speakers that'll be there. So
okay, perfect. And you get more information of that at securitytraders.org. And you can also learn more about Matt's company group at Odeon Capital Group at odeoncap.com. Are we good? Everybody good?
Yeah.
Good. Appreciate you guys. Appreciate everybody who joined us today. And until next month, don't let the shift hit your plans.
Thanks for watching Geeks, Geezers, and Googleization.